And man, yeah, there's kind of a list of things when it comes to things that are changing for this next year. We have AB 1414, which is you have to give people the option to opt out of bundled internet. I know that doesn't apply to everybody, but for some of the larger operators, it does. 620 AB 628 about needing, it's kind of like now it's considered a habitability issue where you have to provide a refrigerator and a stove. AB 325, that's pricing algorithms that you need to avoid and really pioneered in Oakland. Social Security, if Social Security payments are delayed, you can't evict renters. That's AB 246. AB 414 is security deposit return procedures changing there a little bit. And then one other one is AB 747, and it's just some process serving things. And I think it's best practice, but keeping pictures of the processor of serving that and everything. So there's some things there. I'm sure they'll cover some of those things there, and then we'll have a not obviously, but we will cover it online as well. We want to keep you in the know, and so now that all the legislation dust has settled, AOA will be working on the lease agreement to get it updated for 2026. As always, you want to use the newest forms, and even just some of you may have missed it, but there was a major court case in Essegian versus Cepeda back in the summer, and that caused everybody across the state to have to change their 3-day notices and other notices too for yeah. So just all that to say, make sure you're using the newest forms always. And then also, those were all in-person stuff. November 21st, we have a Zoom slash YouTube presentation with how to be proactive about rent debt collection. And so lots of good stuff coming up. Again, we're just trying to keep you in the know and get you ideas that'll help you make and or keep more money than ever before. And so YouTube's a great platform to be able to do this. And I want to give a shout out to Real Estate Transition Solutions for making this specific event possible. They have over 27 years of serving rental property owners. They're DST experts with over 800 exchanges completed, and they do have 4 offices on the West Coast, including Orange County and San Francisco here in the state. And they're just doing high volume in replacement property. It looks like 220 million. Those numbers may fluctuate, but anyway, definitely one of the main players in the industry for sure. And so our speaker today is a partner and chief exchange strategist at Real Estate Transition Solutions. He's a CPA with extensive 1031 exchange, expertise in 1031 exchange strategies and tax deferral strategies. And he leads Real Estate Transition Solutions team of skilled advisors and analysts, serving both as an advisor and an advocate for owners of highly appreciated real estate. And I know for a lot of you that are watching, that's you. You have highly appreciated real estate. You made a good decision a long time ago. Making money is not easy. So it's not that this is an easy thing. Some people call it passive income, but that's you on this call. Congratulations. Some of you are just getting into it. Maybe not. Maybe it's not you right now. But our speaker today, he regularly contributes to educational articles. To, like Business Insider and others, demonstrating his profound knowledge in the field. So it's really a pleasure to have Austin Bowlin with us today. So thank you for being on the call with us here, Austin.
Jeff, thanks for hosting and allowing us to participate today.
Thank you, thank you. And well, I'll let you kind of take it away.
All right, perfect. I appreciate the introduction there. As Jeff mentioned, my name's Austin Bowlin. I'm a partner here at Real Estate Transition Solutions. Today, we're going to be discussing how you can use 1031 exchange dollars to ultimately have ownership of a REIT, a real estate investment trust, and doing so on a tax-deferred basis. So we're going to dive into the content at hand today. You see an overview of what we'll be discussing. And we'll give a little bit of background on the 1031 exchange itself, just to make sure everyone has that foundational knowledge. Then we'll unpack just what real estate investment trusts are, the transaction structure that can be used to ultimately have tax-deferred ownership of a REIT when coming from sales proceeds of an investment property. And that's by way of what's called a 721 UPREIT exchange or UPREIT transaction. And then we'll compare and contrast a traditional 1031 exchange with the 721 UPREIT, some of the attributes associated with each transaction structure, the pros and the cons associated with them. And then I'll make sure to save time for both an illustrative example as well as some additional educational information available to everyone in the AOA community. Now, one of the replacement property options that we'll be discussing today and can be used as a vehicle to ultimately have REIT ownership is what's referred to as a DST, or a Delaware Statutory Trust. DSTs are unique in that they're both eligible as like-kind property for 1031 exchange purposes, but also treated as securities per the SEC, the Securities and Exchange Commission. And specifically, they're referred to as Regulation D securities, which requires any investors to be accredited. Now, accreditation is achieved by virtue of having a net worth in excess of $1 million, not including the value of one's primary residence, or alternatively by having annual income in excess of $200,000 if a single individual, $300,000 if married filing jointly. That accreditation is a requirement in order to utilize any of the strategies that we'll be discussing today. A little bit of background on our firm. Who is Real Estate Transition Solutions, or REITs as we're commonly known. We're a real estate advisory firm that focuses on serving property owners that are navigating the transitions between what we consider to be the third and the fourth quarter of property ownership. Often, these are individuals who own investment real estate that has appreciated significantly over the years and decades of ownership. And they recognize that real estate ownership is dynamic. The physical properties they own change over time. The tenant profile can change, market conditions change, the interest rate environment, the regulatory environment changes faster than any of us would like. And on top of that, owners' objectives change as they go through the various chapters and decades of life. And because of that level of dynamicism, what that leads to is a scenario where often the investment real estate that an individual or a couple may own at one point is no longer consistent with their objectives. Be that an increased emphasis on cash flow in the future, or stability and predictability of that income, or starting to give more consideration to estate planning or liquidity or diversification, whatever it may be. There's a gap between the investment real estate owned and one's objectives. The work we do is to come alongside investment property owners, help to analyze the property they own, educate them on the options available to them, and if there's a better solution, then help facilitate that transition into replacement property that will be more reflective of their objectives for the years and decades to come. By virtue of that work, we complete a healthy number of 1031 exchanges with our clients. You can see here that we've completed nearly 1,000 1031 exchanges with our clients. We specialize in fractional ownership of large institutional properties. That's primarily utilizing the Delaware Statutory Trust structure. As it stands today, we have just over $1.5 billion of DST real estate under advisement. I've completed nearly 2,000 individual investments into DST properties among just over 300 individual trusts. Here's a quick snapshot of a few of the key individuals in our firm. We're actually headquartered up in the Northwest in Seattle, Washington, with offices in Portland, San Francisco, and Orange County as well. And we have a whole team of exchange advisors that are very equipped to help property owners navigate that transition process. So with that background on our firm, let's dive into the topic at hand today. What are 1031 exchanges? Well, 1031 exchanges are a transaction that's made allowable by, as the name implies, Section 1031 of the Internal Revenue Code, of the tax code. And what it allows for is an individual or entity that owns investment real estate, provided they follow the necessary steps, to take all of the sales proceeds resulting from the sale and reinvest into what's considered replacement property. And that replacement property can ultimately defer all of the tax liability that would otherwise be due into it. And you'll hear a term that's commonly used as it relates to 1031 exchanges, and that's like kind. The property that's sold, the property that's purchased, they must be like kind with one another. As far as geographic limitations, the property must also be located within the domestic United States. But let's circle back on that like kind term. The IRS does not care about the property type itself, which many people, when they hear like kind for the first time, assume that that's a reference to. Instead, they care about the intent as to why the property is owned. And importantly, all property held for business or investment purposes is like kind with one another. So you can sell that single family rental or that duplex or that 8-unit or 20-unit apartment building and exchange into any property type, provided it's held for business or investment purposes. Additionally, you can very easily exchange into multiple different property types, thereby creating diversification. So it opens up a myriad of different strategies as it relates to building a diversified portfolio, accessing markets where you see more growth opportunity associated with it, more favorable regulatory environment, and the like. There's a number of reasons why people would consider a 1031 exchange. And first and foremost, it's tax deferral. When you sell investment real estate in California, you can be looking at a very high tax rate applied to those sales proceeds, as high as 42.1%. That's going to be inclusive of federal depreciation recapture tax at 25%, net investment income tax at 3.8%, and California state income tax at 13.3% potentially. There's also a number of other motivations for performing an exchange. It could be time management. You may be wanting to get rid of a property that is time consuming from a repairs and maintenance or a tenant standpoint and go into something that is less involved or perhaps entirely passive. You may recognize that you're concentrated in your asset base. You own one property type in one geographic location, such as residential properties in Southern California. And you recognize that there's some exposure to that if there's a sweeping regulatory change or, heaven forbid, a natural disaster or a change in market conditions in that local market. So you want to diversify among different property types in different cities around the United States. It could be due to stage for estate planning purposes. How do you position your investment real estate portfolio in a way that's going to be conducive for an eventual transition to a surviving spouse or beneficiaries? Or perhaps it's a change in the return profile. There are classic examples of properties that are weighted disproportionately toward appreciation as opposed to income, i.e. single family rentals. And perhaps at this chapter of life, this point of life, you're saying, I'd like to have more cash flow coming in from my property and stability and predictability within that cash flow. All of those factors and more can be motivations for performing an exchange. Now, within the space that we specialize in, fractional ownership of institutional properties, that's primarily going to be by way of the Delaware Statutory Trust ownership structure. Because within DSTs, you can exchange into owning a portion of large institutional properties. The term institutional property, what we mean by that is properties that will range in value typically from, say, $20 million on the low end to as high as $200 million in value. These are commonly properties that you'd see being acquired by the likes of a real estate investment trust, which we'll speak more about today, a life insurance company, a pension plan, a university endowment, properties that are of a certain size and typically quality that are often too large for the individual investor to acquire themselves. And there are multiple different property types themselves within the institutional umbrella. All of these property types have different return profiles associated with them, different considerations, different opportunities, and the like. Now, Delaware statutory trusts have become a very popular replacement property option for a number of reasons. One, it's an entirely passive investment. There's no management responsibility on part of the actual investors. Two, there's little to no closing risk associated with acquiring DST interest. So the likelihood of a failed exchange is very, very low. Three, these tend to be higher quality institutional properties that provide more stability and predictability throughout various market cycles. There's estate planning benefits, there's diversification, there's financial planning strategies available with DSTs. There's the opportunity to shelter a meaningful portion of your income from being subject to tax by way of depreciation. That's often a very common motivation for our California clients whom we work with, given the state income tax applicable in California. And then lastly, for those who need debt on their replacement property in order to have full tax deferral, you can do so with non-recourse debt in the context of Delaware statutory trust. Now, it's not a silver bullet. It's not the perfect replacement property option for every owner profile. There are considerations that need to be taken into account, such as structuring costs, the fact that it's an illiquid investment, the fact that if there were changes to the tax code down the road, that could have a meaningful bearing on the investment strategy. And do remember, it is only available to accredited investors. Now, 721 UPREITs. What are they? How do they work? Let's start with just what is a real estate investment trust. A real estate investment trust is another ownership structure that the IRS approved, this time back in 1960, as a way for individuals to pool their funds together, acquire large institutional properties and often diversified portfolios of property, and then receive the economic benefit of that property without having there be a layer of corporate tax between them and the property. So previous to the real estate investment trust structure being approved by the IRS, it would be common to own investment real estate if it were to be a large institutional portfolio by way of, say, a C Corp. But you have corporate tax that has to be paid on the income in which the C Corp receives. Then dividend distributions are made to the investors. And again, income tax would then be applicable on an individual investor basis. The real estate investment trust structure is effectively a pass-through entity. It doesn't require tax to be paid at the entity level. Instead, all of the income can flow directly to the investors, and then each individual just recognizes their own ordinary income tax rates on the taxable income, still very much benefiting from the depreciation that the properties are generating as well. Not all of the cash flow has to be distributed. Some cash flow can be retained to maintain the portfolio, grow the portfolio, and then new investments made into the REIT can also be used to then acquire new properties. And there are a number of different ways to classify REITs. We can classify them based off of the liquidity provisions and the market structure that they use: public, private, public non-traded. There's the investment strategy within the REIT itself. Is it focused on acquiring properties or financing properties? This would be the difference between equity and debt REITs, or a combination of the two. The one common theme is it must focus on real estate specifically. And then there's sector focus, there's property type focus. Some REITs are pure play from the standpoint of they only acquire, say, multifamily properties or office or hospitality or industrial. You name the property type, there's probably a REIT that focuses on that. Many of which are also diversified among multiple different property types, so that then they can reduce the exposure to a market cycle that may impact one property type disproportionately. REIT investment is a major part of the institutional real estate sector. There's over $1 trillion of investment real estate owned within the REIT ownership structure. And often we'll field the question of how does one ultimately use tax-deferred exchange proceeds or tax-deferred proceeds upon the sale of a property to have REIT ownership. Well, what REITs can do on a tax-deferred basis is they can actually absorb a property. They can go to a property owner and they can say, you own this, let's say, 250-unit apartment building that fits within our REITs investment strategy. And we would like to absorb your property up into the portfolio. Instead of buying it from you, giving you cash consideration, we're actually going to give you ownership in the REIT as your form of consideration. That is what is considered a 721 UPREIT transaction. And so that's a sound and established transaction structure that REITs utilize. And they love to utilize it because there's no cash outlay required to have the portfolio grow. The problem with that is that most of us individuals do not own properties that would fit within the scope and the strategy of the REIT. The REIT isn't interested in having a single family home or a 10 unit or 20 unit apartment building in their portfolio. So it's not feasible often for an individual to just have their property outright absorbed. Now, why would someone consider contributing their property to a REIT? It's so that they can defer their tax liability, so they can have diversification, so they can have the income stream coming from the REIT portfolio as a whole, as opposed to their single property. It's also going to allow flexibility around debt financing once in the REIT and the like. So there's a number of options here. But the problem is, as I mentioned before, most of us don't own properties that REITs are interested in absorbing into the portfolio. So that's where a Delaware statutory trust that's specifically structured in order to go up into a REIT can come into play. There are DST properties that the intended exit structure from that DST is not to be sold eventually 5 to 7 years down the road, and then the investors make a subsequent exchange, but instead actually absorbed up into a REIT portfolio. And then, so all the individual property owners sell their respective properties, exchange into a single DST property or a portfolio of properties, and then after a 2 year hold period, that property is ultimately absorbed in the REIT. The benefits of this structure are similar to that of the traditional DSTs, but there's also additional liquidity, additional diversification, and some estate planning strategies that can be made available through the UPREIT structure. Now, just like the Delaware Statutory Trust, the standard traditional Delaware Statutory Trust, it's not a perfect structure for every investment property owner profile. There are considerations that must be taken into account. And one of the primary ones is the fact that once you contribute your ownership up into a REIT, that's a one-way street. You will own that REIT until you ultimately decide to sell your shares and pay tax at that time, or hold those shares until eventually a step up in basis is realized and a surviving spouse or beneficiaries can sell those shares on a tax-free basis. Understanding the REIT manager, the REIT strategy, the financial metrics within the REIT are critical because it is very much a actively managed and traded portfolio that can change over time and will inevitably change. And then, like all liquid investment structures and the 1031 exchange and anything that leverages the tax code, changes to the tax code could have implications for this particular strategy. Traditional 1031 exchanges versus the 721 UPREIT structure. With the traditional 1031 exchange, you have a timeline that you have to adhere to. 45 days to identify the property, 180 days to actually purchase it, equal or greater property value requirements, identification limitations, and the like. None of that is present with the 721 UPREIT because it is just the outright absorption of a single property. Additionally, you can go into a portfolio that has any number of property types within it. And to be clear, when we work with 721 UPREIT DSTs, you know the actual REIT that property will be going into when you are selecting that DST property. What you don't know is exactly what will be in that portfolio 2 years down the road when they absorb the property into it. Inevitably, there will be changes to that portfolio between the date of the investment and the ultimate absorption. And here we have just a quick visual of this process and what it looks like. So if someone owns a individual investment property and they're ultimately wanting to have REIT ownership on a tax deferred basis, the steps in this transaction process include first selling your property to whomever's willing to pay the most. You approach the sale just as if you were planning on paying tax. You engage a broker, you list the property, you accept offers, you go under contract, and then ultimately the property is sold. You then, while you're under contract, set up a 1031 exchange and exchange into what's called a 721 UPREIT DST. This is the vehicle to aggregate all of the individual investors into one large or a portfolio of large institutional properties that the REIT then plans to absorb. You'll have ownership of that DST property for typically 2 years. This is a seasoning requirement per the IRS. And then after that 2 year period has lapsed, the property will then be absorbed up into the REIT, and your ownership will convert into effectively shares. Technically, they're called operating partnership units, but effectively shares of the REIT portfolio at large. So you may go from selling a $1 million property to exchanging into a $200 million property, owning a portion of that for 2 years, and then after the absorption occurs, now owning shares in, say, a $5 billion REIT portfolio. There are also two subcategories of 721 UPREIT DSTs, one of which is what we call hardwired UPREIT DSTs. This typically has a shorter hold period, 2 years, as I referenced before, and every investor who exchanges into that DST will ultimately have REIT ownership. They are forced, for lack of a better word. Everyone will be going into their REIT. There's also what's called a hybrid UPREIT structure. Here we see a little bit longer hold period, more commonly in the, call it, plus or minus 5 year range. And then after that period of time, there will be a two-part transaction where the REIT will offer cash consideration for anyone who wants to exchange out of the property or pay tax, and then absorb the remaining investors up into the portfolio. So there's some optionality with that latter structure. Who are the profiles for whom the 721 UPREIT structure can be a good fit? Well, there are individuals who want purely the simplest option available to them, and they don't want to have to make future 1031 exchange decisions down the road. They're not concerned about the optionality or the flexibility. They want to ultimately sell their property and then have long-term ownership in something that's broadly diversified, income producing, and they're not going to have to make future decisions for. That can be a good fit. Another is someone who wants to have the liquidity provisions that the REITs will make available, whereby you can sell shares after you have REIT ownership. Typically, there's a 1 year lockup period at your discretion when you want to sell shares. So there's some tax planning strategies that can be implemented here because of the liquidity. If you have a loss in 1 year, you could sell $50,000 or $100,000 or $500,000 of shares to offset that loss. Or you can gift shares to beneficiaries. Or you can choose to sell the shares immediately after, say, a spouse passes away and a step up in basis is realized. Another is the individual seeking maximum diversification. With the traditional DST portfolio, it's very feasible to build a diversified portfolio of, say, $300, $500 million of real estate. But if you're looking for $5 billion, $10 billion of diversification, then the UPREIT structure may be a good fit for you for all or a portion of your exchange proceeds. The liquidity provisions also have implications for estate planning, given you have that flexibility to sell the shares immediately after the step up in basis is realized, as opposed to potentially having to wait a few years until the underlying property is ultimately sold. Now, how does one go about identifying 721 UPREITs? The best way, if you are interested in learning about this particular structure and the options available, is to reach out to our team and have a conversation with one of the exchange advisors on our team. Because the reality is, what's often overlooked in 721 UPREITs is the underlying due diligence on the REIT itself. Ultimately, that is your long-term home. And while we're performing due diligence on the REIT as it is today, understanding that it will look slightly different 2 years from now, it's critical to evaluate all of the metrics that are in play for the REIT, the leverage on the portfolio as a whole, the maturity dates of the debt on the portfolio, occupancy rates, the FFO, funds from operations, modified funds from operations, adjusted funds from operations, the dividend reinvestment participation, all of these considerations, inflows, liquidity provisions, et cetera, to determine if this is the right long-term investment for a particular property owner. Quick snapshot of two 721 UPREIT DSTs that we worked with recently. One here falls in that hardwired category, 2 year hold period. This was put forward by a firm we work with called Hines out of Houston, Texas. The property itself was a Class A multifamily property in San Jose, California. And The other is a hybrid UPREIT. This is an industrial portfolio that was structured by a firm called Blue Rock. Ultimately, will go into their industrial REIT, but you'll have the option of receiving cash proceeds at the end of the hold period of the DST. And then a quick glimpse of from 20,000 feet, our due diligence process that we work through when evaluating DST sponsors, properties, and then ultimately the REITs in this particular conversation that would be the long-term home for the investors. Why work with an exchange advisor? Well, we have a significant amount of experience, 20 plus years, and having navigated thousands of 1031 exchanges. I'm working with our clients. We have an in-house due diligence team, 5-person team that spends all their time analyzing and vetting the sponsors and the underlying properties. And on top of all of that, are also very much focused on educating property owners on the options they have available to them, as well as taking the time to learn and understand each individual property owner's unique objectives. That is critical, in our opinion, to ultimately be presenting the recommendations for that investor that are going to be tailored to address their specific objectives. If you're interested in seeing currently available or illustrative closed properties, you can do so by visiting our AOA hub page. That's our website, re-transition.com/AOA, in which case anyone can see closed properties that are no longer available for investment, and you can request access to see currently available properties as well. As far as additional educational resources and opportunities go, if you have any questions following today's presentation or would like to discuss the specifics of your situation, we are always happy to have a conversation with you. You can reach out via the number you see at the bottom of this slide or by visiting our AOA hub page, in which you can schedule a consultation directly on the calendar of one of the exchange advisors on our team. That's a great opportunity for us to share specific resources with you. It'll be that webinars, our guides, white papers, articles, etc., to help you work through the education process. Our guide to investing in DSTs is also available for download on our website. This is a great resource if you're interested in learning more about the DST structure, the history, the mechanics, and strategies available using DST replacement property. And then lastly, webinars are a near weekly occurrence here at REITs. We also make all of our webinars available on demand. If there are any topics that are of interest to you, you can view those at your leisure, whatever time is convenient for you. And you can find those recorded webinars again on our AOA hub page. Well, Jeff, that was a lot of information. I was moving pretty quick there, but that's all I have on my end if we want to open it up to some Q&A.
Great. Yeah, if you're watching from AOAUSA.com, there's the blue help button there at the bottom right corner of the page. You can type your questions in there and they'll funnel that over to me. If you're on YouTube, you can type your question in there. We have a few questions already,
Perfect.
so we can get to those. Does your company charge any fees directly to investors for services related to a 1031 into a DST or a 721 into a REIT? If so, what type and percentage? Not
Good
asking
question.
about sponsor fees.
Yep. So the way we're compensated is akin to if a property owner worked with, say, a commercial real estate broker to go acquire another property. And what I mean by that is we serve as buyer's representation, and we're paid technically by the DST sponsor for representing the investor into the property or properties. It's not an out-of-pocket cost per se for the individual investor. Anytime we quote a projected first-year cash flow rate, it's always going to be based off that investor's full investment amount, and it's effectively built into the purchase price of the property. Usually, our compensation is in line with commercial real estate brokerage commission, so typically somewhere between 2.5% to 3% of replacement property value acquired.
Okay, great. Let me get this over here. Okay. One point that I'd like to hear on is a ROR over the DST duration, 5-year, 7-year, etc. Are these private REIT or public REIT? Most private REITs I've seen through the years have had a negative ROR over time.
Good question. So In terms of rate of return, we will typically use the what's called an average annual return. So that's going to be the average cash flow over the hold period plus the average annual appreciation over the hold period. If you were to invest in a DST that had, let's say, 5% average cash flow, and then it was held for 5 years and appreciated 20% by the time the property was ultimately sold. So you invested 100,000 into it and then ultimately received $120,000 of sales proceeds. That 20% divided by the 5-year hold period, that would be 4% average annual appreciation. So the 4 plus the 5, 9% average annual rate of return. The average annual rate of return that we underwrite to is typically in the high single digit, low double digit range. It depends on the property type and, of course, market conditions to a certain extent as well. And then ultimately, the hold period will have some bearing on that. When we look at the REITs themselves, typically what we see is, depending on where you're buying at in the market cycle, because these REITs are what are commonly referred to as NAV REITs, NAV REITs, in which they post a share price on a monthly basis using an appraisal methodology. So they're not publicly traded. They're going to be either public non-traded or private REITs. And there's a couple schools of thought as to whether it should be a private REIT or a public non-traded REIT, some limitations from state regulators and the like. So that's something that if someone wants to discuss further, we'd be happy to do so. But usually we see the REITs having distribution rates somewhere in the 5 to upper 6% range. And then where you're investing in the REIT from a market cycle standpoint will have a significant bearing on what the appreciation on the share price will be. REIT values have come down significantly since the early 2020s, 2022 specifically, which was peak pricing for the REITs. So it's very much looking like we're in the trough and early innings of the recovery, and hopefully, that'll be a 5-7 year expansion in which we see those share prices continuing to grow.
Great. All right. What is the upfront load cost to buy a DST?
So the delta between the acquisition price of the underlying real estate and the offering price at which it's made available to the investors in the 721 UPREIT structure is typically somewhere between 7.25% and 7.5%. So that's going to cover all the structuring costs, the acquisition fees, any sort of financing fees that are in place, loan origination and the like, third-party due diligence reports, distribution costs, et cetera. And in some regards, you can look at that as kind of the hurdle in which that property needs to appreciate somewhere around 7% in order for then there to be a full return of principal to the investors when the property is ultimately sold.
All right, great. And yeah, so also, guys, that's all the questions that I see right now. We do have a seminar at 12 o'clock, and that's about the soft story retrofit. Okay, I hear they're putting in another question here, so they're getting that over to me. So give me a second there. Yeah, so they'll be talking about just soft story retrofit, the balcony. Oh no, the balcony and stair inspection deadline being at the end of the year. So there's going to be a live stream about that coming up at 12. And here it is. Okay, is it hard to sell REIT shares?
Typically not. So the REITs that we work with will all hold liquidity on hand to satisfy what are called redemption requests, share sales by the investors. They will have guidelines and some limitations that they can place on how the volume of shares that are sold in typically a given quarter and cap it for the year as well. Usually it's 5% quarterly, 20% for the year. And the REITs have to have that in place so that they're not forced to sell properties in the portfolio at a time that's disadvantageous for the portfolio in order to satisfy redemption requests. All the REITs that we work with right now are satisfying redemptions in full. So if you said, I want to sell shares in early November, you would have that sale would be executed at the latest within the course of the quarter, but likely that month. So there's no queue that's being built. But if for some reason they hit the limitation, they would prorate you. They would satisfy whatever percentage they can up until reaching that cap and then move you to be in first position in the next quarter to have redemptions come through as well. So no, it has not been an issue with the REITs that we work with. Now it has been an issue, especially a year or 2 years ago, within other REITs. Starwood, for instance, had a big redemption queue, and it was taking upwards of a year for investors to get capital out that they were interested in selling shares for.
Okay, and just one other question. What's your take on the tokenization of REITs?
I mean, something that we've heard talked about for probably 3, 4 years at this point, not received major adoption. I mean, I
Hmm.
think that there's a lot of opportunity within real estate ownership, title and escrow, especially to have blockchain and tokenization play a role in that. So that's exciting, but it's not reached the level of scale in which we really need to plow much time into it in earnest.
Great. Okay, looks like we got one more question here from
Sure.
James. One last one. Slowly as it's being typed in here. All right. Okay, does that mean when I roll the REIT after 5 to 7 years, I'll have a lower amount invested?
Not necessarily, because any and all property level appreciation that the property realizes legally has to go back to the investors themselves.
Gotcha. Okay. Well, hey, I think that does it for now. And we appreciate you and your expertise in the field for sure.
Excellent. No, my pleasure. Always a pleasure to share with the AOA community, Jeff. Thanks for the opportunity.
All right. Do you have any in-person things you're doing in California?
We actually just hosted one on Tuesday up here in Seattle, and we're currently building the 2026 schedule for
Okay.
presentations, and I believe there will be a couple that pop up in Southern California, specifically, probably Northern California as well, throughout the year. So I'll make sure to share that with the AOA community so that then folks can join us if they're interested in doing so.
Excellent. Thanks again.
All
Thanks
right.
everybody for joining us.
Thank you,
Take
Jeff.
care. Okay, bye-bye.